today. I'm going to bring up my presentation. And as always, this presentation is for you. And so if you have any questions as we're going along, please feel free to stop me. Next, I'll just make a quick announcement. Most of you are familiar that I do the Social Security and Medicare presentations next month. If you do have questions regarding Social Security and Medicare, I'd highly encourage you to attend those. A lot of good information within that if you have the time to join us. And I do split Social Security into two different, one's a primer or a basic, and the second one is an advanced Social Security. And I apologize, one second. Okay, apologize. My daughter's iPad was a little bit loud there. And next month for the IIG, I will be doing what I call the 7% solution, a unique strategy that we employ that I have a lot of information on. I did send some information out to a couple of you on it. We call it the 7% strategy because it helps our retirees in retirement with their RMDs, among other things. And I'll be going over that next month. So that's just a unique strategy that we like that involves dividend stocks. So if you're interested in dividend paying stocks and a way to supersize income off of dividend stocks, that's what and protect a significant part of the downside. That's what I'll be discussing next week. Okay, so let's jump into annuities now that I've had to tell my daughter a couple of times to turn on her iPad. Here's the dilemma. Markets are getting less predictable and return expectations are declining. But does that mean investors need to sacrifice their income or their income needs? And if they're not willing to sacrifice their income or their income needs, what can they do as an alternative to a typical 60-40 stock bond portfolio? Most of you, of course, were investors in around in 2022 to see that a 60-40 portfolio took a pretty big hit because of the rapidly rising interest rates hurting the bond or fixed income side of the portfolio. And then, of course, stocks sold off as well because as the interest rates come up, the required rate of return or the capital required in the company becomes more because of higher interest rates, and therefore returns become lower, and that's why we saw a precipitous decline in equity prices as well in 2022, which is pretty anomalous if you go back in history. You don't normally have stocks and bonds in lockstep like they were in 2022. But what would have been something that would have helped cushion that blow? Well, I would argue that an annuity, if you understand the way it works and you have the right type of annuity, that can act as a very nice cushion for years like 2022. And here's the issue. And of course, interest rates have come up since this slide, but I still think it drives home the point that, you know, it says current yield as of December 31st, 2020 was 1.12% on the on the U.S. Barclays aggregate. That's come up to roughly 4 to 5%. So it's, you know, significantly higher than it was back then. But the reality is there's still interest rates historically are still way below their historical averages, okay? Even with as much as interest rates have come up, particularly if we look longer out on the treasury curve to the 8, 10-year, 12-year, 20-year treasuries, the interest rates are not what historically they have been. And therefore, if you understand how bonds work, if I just take this little IV packet here and you look at a bond, on one side you have interest rate, right? And on the other side you have price. And so if interest rates come down again from where they are now, then the price will go up. But realistically, longer term, as bond rates normalize, meaning they go back to their normal rates, we're probably going to see a increase in interest rates, especially on other parts of the interest rate curve that are further out from short-term treasury rates. We're going to probably see another potential price decline in medium to longer term bonds, which is going to offset some of the income you get from those bonds, okay? Realistically, longer term returns on bonds from a longer perspective are going to be muted as compared to if you were purchasing bonds in the 80s and 90s to balance out your portfolio. Again, this slide is a little bit old, but just I think what is important here is to understand it takes more to generate 40,000 of annual distributions. If we look back to 1990, right, the S&P 500, we needed approximately 1.3 million in the S&P 500 to generate that 40,000 because of the dividend yield. On the 10-year Treasury in 1990, we only needed 500,000 to develop because the 10-year Treasury was well over 5%. Even today, as interest rates have come up significantly, the 10-year Treasury sits more in the 4% range and is still you would need roughly $1 million in the 10-year treasury to about that 40,000 in income. 6-month CDs have definitely come up, but even if you get 5% on a 6-month CD, okay, you still need roughly $800,000 in that CD to generate the 40,000 income. On the other hand, a variable annuity distributing 5% can guarantee you that 8%, or excuse me, that 800,000 will generate that 40,000 income for the rest of your life. And it has been so since 1990, and as recently as 2020, variable annuities were paying out 5%. And most variable annuities now are even paying 5, maybe 6, and sometimes even up to 70%, depending on the specific riders. So an annuity can be a way to have protected income that is different from a tax standpoint as well. CDs, obviously, you're paying ordinary income tax at state and federal level on the interest. Annuities have a component of them that can give you significant tax deferral, and from a longer term perspective could be very beneficial if you're not taking income right away and you're deferring some of the income. All right. Again, this slide reiterates, and it's a little bit old versus today, but it reiterates if we go here to 2010, when the 10-year treasury was at roughly 3%, and it's not much above that today. And so there's not much of a cushion to fall, whereas back in 1990 and even in 2000, you had a lot of room for treasury yields to fall, which would be a tailwind for your bonds because your prices would be going up. So let's talk about some of the basic facets of annuities. And again, I'll monitor the chat. If you have a question, please step in. I may miss that you put something in the chat, but let's talk about the basics. Because I think if I have to put it in perspective, annuities are the most misunderstood product in the financial services world. I mean, there's some more difficult structured notes and all the stuff that may be a little more difficult, but they're not as often spoken about. I think annuities tend to get a bad rap sometimes. Ken Fisher from Fisher Investments has made it his mantra that he never does an annuity. Annuities are bad and this and the other. And then you have some other firms that all they do are annuities. So what really is an annuity, and where would it fit and where would it not fit? And we'll go through a case example here at the end. So let's talk about definitions, basics, how they work, the products, and then different types of payments and distributions. So annuity is just simply a contract between two parties, right? The insurance company and the insured. So you as the insured and an insurance company. Insurance companies can range from all different types, from really good, reputable insurance companies, New York Life, MetLife, Lincoln Financial. One company has been around since the late 1800s, and then some not so reputable companies are also in the same business. The insurance company agrees to pay the insured an agreed upon benefit, either in the form of a regular interval or in a lump sum. All right. What does it essentially mean? Annuity allows you to save on taxes and drive benefit at retirement. Your pension at UCSD is essentially an annuity, right? UCRP has a guaranteed payout that they are going to pay you for the rest of your life based on which retirement benefit you take. That essentially is the same thing as an annuity. So when people think about annuities, think about it as a different form of a pension. If you don't have a pension, sometimes I tell people that aren't as fortunate as UCSD members that don't have that pension in their life, that if they want some form of a pension, an annuity is an excellent way to build out a pension, right? And annuities most simply accumulate funds and then are later repaid to you either in a fixed term, say 5 or 10 years, or the rest of your life. Annuities are very similar to a certificate of deposits, but they have much better tax facets than CDs do. CDs are offered by banks. They're protected by FDIC insurance. Annuities, very common for people to not catch this concept when it comes to annuities. Annuities are backstopped by every state insurance commissioner, right? So there is a general fund, we'll talk about here in a second, that actually protects the funds in your annuity. Not necessarily the income in the riders, but the actual amount in that annuity is protected. All right, so who offers an annuity? Sold by insurance companies by way of licensed agents. Most financial advisors, people in my profession, people that work at Fidelity are duly licensed, not only in securities, but also in insurance. To be able to sell annuities, you have to be appointed in the state of which the customer or the potential insured lives in, and you have to be appointed with that carrier, specific carrier, in the state that you are speaking to someone about potentially purchasing an annuity. State and federal, that's why it says you should check licenses of the insurance broker that you're speaking with if you are looking for an annuity. I'm insurance licensed California, Nevada, Actually, most of the 50 states, I believe, that we have clients in, I am insurance licensed. And then as far as different products, whether it's a New York Life product or a MetLife product or a Lincoln product or any one of the other insurance companies, that's dependent on usually what the fit is for the client. And then I get appointed by that particular carrier. So how does annuity work? The insured makes a deposit with the insurance company, either as a single payment, or you can, just like you would into a mutual fund or as you would into any type of investment strategy, you can dollar cost average into an annuity very similarly. You don't have to necessarily put all the money in there at once. And depending on the type of annuity you choose, the money deposited with the insurance company will either earn a fixed or variable rate of return. That's why you get what are called variable annuities or fixed annuities. All right, so the different types of annuities. A single premium immediate annuity, or a SPIA as they're sometimes called in the industry. So that's when you just take a big lump sum of money and you give it to the annuity company, right? We're going to talk about ways that you get money back here in a second, or payment methods or distributions. Single premium deferred annuity. So on the immediate annuity, you're just getting immediate benefits from the day you put the money in. So yeah, of course, a portion of that's coming back to you as your principal, a portion of that's going to be also considered ordinary income or taxed that way, depending on the structure. A single premium deferred annuity, right, is the amount paid in a lump sum, but the withdrawals can be made only after a specified time limit. You may say, well, why would I want a deferred annuity if I can take income right now? Well, let's say you're still continuing to work, but down the road you want an annuity potentially to pay property taxes on the home you're in, and you want to set aside a certain amount of money. Or you may want an annuity because it gives you a certain amount of income, but you want tax deferral right now because you're a high tax bracket now, but you're not going to be down the road. Or you want to just have tax deferral and you've maxed out your 403B and 457, and you have some other funds that you want to grow, but you don't want to add to your taxable burden. A single premium deferred annuity is certainly a way you can go about doing that and get the tax deferral that you're looking for. We use a lot of annuities when it comes to estate planning. If you are funding what's called an irrevocable life insurance trust, an annuity will often be a great product to structure that as well, those payments, because they're usually level. Annual premium deferred annuity is just a premium paid to the insurance company, either in the form of quarterly, monthly, or biannual or annual installments. And then withdrawals are also deferred to a later date, hence why it's called deferred annuity. And then at the bottom, a variable annuity can be a combination of any of the above. It could be a immediate annuity, it could be a deferred annuity, it could be an annuity that you're putting payments into on a quarterly, semi-annual, annual basis. And then at some point later on in life, if it's a deferred variable annuity, you would be taking withdrawals off. The variable part of an annuity is what the variable part comes from is that it is variable based on the underlying investments. They're going to have different mutual funds in the annuity contract. So it's essentially mutual funds with a insurance chassis around it. And that's why it's called a variable annuity. So how does annuity work? Just a contract, again, between you, the purchaser and owner, and insurance company, the annuity issuer. In its simplest form, you pay money to an issuer, and the issuer pays out the principal and earnings back to you or to a named beneficiary, dependent on how you structure the annuity. Life insurance first developed these annuities to provide income to individual in their retirement years. This is well prior to Social Security and other forms of retirement, 401k, 403b, 457. Annuity companies were essentially the only form of some type of guaranteed retirement benefit. So let's talk about some basics. So here are some different annuity companies you've probably heard of: John Hancock, AXA, Prudential, Pac Life, MetLife, Fidelity, all different annuity companies. I think you see Fidelity in there. I know a lot of you are familiar with 403B and 457. I have never placed an annuity with Fidelity. I think some of these other companies actually have better products. So I know many of you are comfortable with Fidelity because of 403B and 457. But if you do end up looking for an annuity product, make sure you look outside of just the Fidelity sphere. There may be some better products out there with higher payout rates and more things that you may be looking for. Just don't limit yourself to Fidelity would be my only advice there. That's not to say that Fidelity may not have a great product. I would just make sure that you're researching more than just one. So who purchases annuities? Well, most annuities are purchased by people over 50, right? Less than 50 years is 43%, but if we take the 40, that's from 50 to 64, and the 17, you can see about 57% of people are over the age of 50. What's kind of the age limit on an annuity? I would say you're really not looking to purchase an annuity if you're in your 70s, late 70s, early 70s, mid 70s. Anytime from then on, very rarely are we looking at annuities. The one exception, again, would be from an estate planning standpoint. And if we're trying to fund some type of life insurance to prevent estate tax, then we may look at an annuity in the 70s, but it would only be for a specific goal with regards to estate planning. I wouldn't necessarily look at an annuity for income planning for somebody in their 70s. What's one of the biggest benefits of annuities? Tax deferral, right? The attractive aspect of annuities is that its earnings are tax deferred until you begin to receive payments back from the annuity issuer. In this respect, annuity is similar to a retirement plan. Over a long period of time, your investments in annuity can grow substantially larger than if you had invested money in a comparable taxable investment, simply because you're not paying taxes on an annual basis. This is very important in California. It's also what makes annuities very popular in California. One of the things of annuity, if you are sitting here and you're in your 50s and you're thinking about purchasing an annuity, you have to realize, just like a qualified plan, you cannot take out withdrawals from an annuity until you're 59 and a half. That's part of what the tax deferral does. Or you have the same penalties that you would have with a retirement plan, and that 10% tax and potentially ordinary income tax on top of the 10% penalty if you withdraw before you're 59 and a half. Unlike a qualified retirement plan, contributions to annuity are not deductible. So that's the big difference between an annuity and a qualified retirement plan. The other big difference is you can use annuities with non-qualified money, which means money outside of retirement plans, right? And that's where they're probably most popular. Although folks that are very conservative investors and they want some guarantees on their investment returns and on their investment distributions, look to annuities as well for some of those guarantees, because they just can't tolerate the market. So benefits associated with annuities, again, the tax deferral we discussed, right? Insurance gets a secured guaranteed return, typically for life. So many of these products come with not only guaranteed increases in the amount of base. Let's say you put $100,000 in and you get a 5% guaranteed step up each year in the benefit base, right? That doesn't necessarily mean the value of the annuity, but the benefit base. And then you may have a guaranteed 5, 6, or 7% withdrawal rate for the rest of your life on that. And you can never run out of money, even though you may take out, 100%, 200%, 300% more than you put into it. Many of these annuity companies are guaranteeing that they will provide those distributions for the rest of your life, regardless of how long you live. As an insurance person once told me, when it comes to annuities, insurance companies, the way they win is by you dying fast on annuities, and they lose if you are very healthy and you stay alive for a long time, because they are going to have to be on the hook for making those payments for the rest of your life. And then with life insurance, it's the opposite. An annuity offers you also immediate savings, ensuring avoiding probate for heirs. I think that's one of the often overlooked things with annuities. It does provide, for example, if you don't have a trust and you don't want to get a trust, but you want to make sure some of your funds that are not in retirement plans are not subject to the probate system. Remember, anything over $100,000 in California is potentially subject to probate. Then an annuity might be appropriate for you. All right, so how do they work? You look over here in this little house or this little diagram. This is the annuity company. You can see in the top left there, premiums are going into the annuity company. It goes into, if you look at number 2 there, the issuing company's general account, all right? And then that flows into the accumulated annuity funds, right? They take out, you can see the left, the fees and expenses. That's how they make money. Potentially a death benefit would come out from that accumulated annuity funds if someone passes away before payments are made. And you can see coming out of the accumulated annuity funds, if it's not going to fees and expenses and not going to people that pass away, death benefits, you have withdrawals before 59 and a half, withdrawals after 59 and a half, and then you have annuitization payments if you decide to actually annuitize the annuity itself. And then down there at the annuity payments, and then you have taxes if it is in a non-qualified account, meaning you put money in tax deferred, then there's taxes. How is that taxed? I think a lot of people think that necessarily when you take out of an annuity, it's all ordinary income. That's not the case. There are a couple products out there, particularly one with Lincoln, that's very interesting because it has a special, let's say you defer taking income out of the annuity for 5 years or 10 years, and you begin taking income. They have a special formula where a portion of that is a return of premium, so it's not taxed at all, it's taxed at zero, and then a portion of it's ordinary income. So they can be very tax efficient in retirement, not just from the standpoint of the tax deferral while it's growing, but even when the distributions are happening, it can be pretty tax efficient as well because the portion that you get back is part of your basis. There are four parties to an annuity contract: the annuity issuer, meaning the insurance company, the owner, right, which is not necessarily the annuitant and not necessarily the beneficiary, right? So they can all be different or they can all be the same. Well, the owner wouldn't also be the beneficiary, but you can make it your trust the beneficiary, so you technically are the beneficiary. So owner, annuitant, beneficiary, and then of course the insurance company. The annuity issuer is the company, example, an insurance company that issues the annuity, and then the owner is the individual or other entity, so an entity could own an annuity as well, who buys the annuity from the annuity issuer and makes contributions to the annuity. So let's get to the nuts and bolts of annuity. There's really two distinct phases of annuity. There's the accumulation or the investment phase, right, where you're putting money in, and then there's the distribution phase where you're taking money out. The accumulation phase is the time period when you add money to the annuity, and when you're using this option, you'll purchase a deferred annuity, right? So if you have an immediate annuity, obviously you just put a lump sum in and you go immediately to the distribution phase. If you have an accumulation phase, then you do have, by definition, a deferred annuity. So let's talk about some of the different products. How are we doing on time here? Oh, we're doing great. So single premium deferred annuity, right? You can purchase annuity in one lump sum, known as a single premium, or make investments periodically over time. The key component here is it's a deferred annuity, so you're not taking income right away. Immediate annuity is simply the opposite. If you want to start receiving payments right away within the first year, you'll be purchasing an immediate annuity. Anything past a year is considered a deferred annuity. Anything a year or less is considered an immediate annuity. Why would you turn over money, like let's say $100,000, and start an immediate annuity right away? Why wouldn't you just, take that money and put it in your pocket or take it out of your account? Well, let's say you buy an immediate annuity and you buy it for life, right? And you put $100,000 in, and you feel like you're going to live for the next 30 years. The annuity company is going to do a calculation of what your life expectancy is, and it's going to give you your money back over the life expectancy. So if you live far beyond your life expectancy, the annuity company is going to be on the hook for making those payments to you for the rest of your life, no matter how long you live. With the immediate annuity, you can elect to receive payments both over your lifetime and the lifetime of another person, known as a joint and survivor. All right, so you can make it a husband and a wife. Under a joint and survivor annuity, the annuity issue promises to pay an amount of money over a periodic basis. You can make it monthly, quarterly, or yearly. Many of you may have heard of like a 10-year period certain or 5-year period certain. There's all these different ways to structure these annuities. And again, that takes a very specific conversation on what the goal of the annuity is. I think often annuities get bad raps because the goals don't match what the annuity is there to do. And then somebody gets stuck in a product. Maybe something wasn't disclosed, like the fact that there's a surrender period for the first 5 years. What's a surrender period? Simply a time frame where the annuity company says, if you go and take all of your money back, we're going to charge you a fee because annuities are supposed to be longer term products. That's something you should definitely ask if you do work with someone on an annuity purchase. You need to know what the surrender costs are, or what are the costs if you want to get your money back. And what I mean by your money back, I mean the lump sum. So lifetime annuity, if you're age 65 and like to receive annuity distributions over your entire lifetime, the amount you'll receive with each payment will be less than if you had elected to receive annuity distribution over 5 years, right? So that's a 5-year period certain versus a 10-year period certain versus a lifetime. Annuities can also be used as charitable gifts. The assets in form of annuity can be transferred to a charity. You receive the payments, right? And a charity is designated as the beneficiary of what's left over. Things that you may or may not be familiar with, but that are very common in the financial world, are charitable remainder trusts, right? And these can be a charitable remainder annuity trust, which is commonly known as a CRAT, or charitable remainder unit trust, which is known as a CRUT, right? What the structure is should be determined between your, goals, your financial professional, and maybe potentially an estate attorney just trying to develop solutions for an estate tax problem. Some of you out there may have an estate tax problem. This would be an example of why you would want to use one of these products with an estate tax problem. Module 5, and we're wrapping up towards the end here. Do I have any questions so far? I'm going to stop for a second, just see if I have any questions. Nothing? As of right now? Okay, well, let's go right back into it then. I guess I'm not seeing any. Sometimes it's hard to get the presentation to go at the same time as your. All right, so distribution options. So we talked about the different ways to accumulate funds. Now let's talk about the distribution options. All right, so you have two options. In the first option, you can withdraw some or all of the money in annuity and lump sums. All right, and the second option, which is referred to as a guaranteed income or annuitization option, which is the most common form of annuity, provides a guaranteed income stream for your entire lifetime, no matter how long you live or for a specific period of time. Again, 10 years, 5 years, 20 years, those are called period certains. Guarantees are based on claims paying ability of the issuing insurance company, right? And the option can be elected any time on your deferred annuity. So you don't have to start it at any given time. It's called annuitization. And they make the payments based over the amount in the contract and over the time period, what their rate of return is. The amount you receive for each payment period will depend on, again, how much money you have in the annuity, right? So the big premium there, you can see at the top. How earnings are credited to your account, whether fixed or variable, right? So this would be fixed at 6%, right? Variable would include sub-accounts, which would have different mutual funds. The age at which you begin the annuitization phase and the length of the distribution period will also affect how much you receive. So there's all these different variables that go into it. And again, this is something you should work with an insurance or a financial professional on if this is something you are considering. Let's compare annuity and other retirement plans. If you've already contributed the max allowable amount to your available retirement plans, an annuity can be an excellent choice. As I said earlier, it gives you the benefit of tax deferral. It gives you some guarantees. It can be a substitution for a pension if you don't have one, or if your pension is not enough to cover your lifestyle and you're very risk adverse, then certainly an annuity would be a good consideration. There's no limit to how much you can invest in an annuity, and like other retirement plans, the funds are allowed to grow tax deferred until you begin taking distributions. Just simply investing in a 401k can cause you to come up short of your overall retirement goals. And so an annuity can be a good choice, a very safe choice at times, depending on how you structure it, to fill in some of the gaps. So when is an annuity appropriate? Well, again, it's important to understand annuities can be excellent tools if they're used properly. And I know there's a lot of times out there when they're not used properly, and I think that's where annuities sometimes get a bad rap. But they actually are very good products, especially if you're very risk adverse, or if you have a significant amount of funds that you want to tax defer and you don't want to pay taxes on it now. It's also a great way to build wealth without destroying it through paying taxes all along the way. Annuities are definitely not right for everyone. And the contributions to annuity are not tax deductible because of the tax benefits of tax deferral. Most experts advise funding other retirement plans first, and I would completely agree with that. I think it's important to, because you get the deduction and because you are in California, if you can contribute as much as possible to your 403B and 457. But again, if you have maxed those out and you are looking for other places to put non-qualified money, or you just want the safety and security of knowing the guaranteed rate of return, that's what an annuity can do for you, because essentially you're transferring the risk to the insurance company. So to summarize, our annuities are designed to be very long-term investment vehicles. Say never purchase an annuity if it's going to be less than probably 7 years and would be your minimum. In most cases, you'll pay a penalty for early withdrawals. That's called the surrender cost. It's very important that you know exactly what that surrender cost is and what that schedule looks like. That's something you should certainly ask your financial or insurance professional. If you take a lump sum distribution of your annuity funds within the first few years after purchasing an annuity, you may be subject to the surrender charges I just discussed, right, are imposed by the issuer. And as long as you won't need the money until 59.5, annuity is definitely worth considering. Remember, prior to 59.5, it has some of the same downfalls of retirement plans in that you're subject to a 10% penalty and potentially ordinary income tax as well. If your needs are more short-term, you should certainly look other places to like short-term treasuries or maybe municipal bonds or something to that effect. So let's look at a quick example. All right, so this is a variable annuity solution. All right, can reduce pressure to stretch for yields, especially if interest rates come down significantly again, and you're not getting but 2-3% for a CD, 6-month CD. So how could a VA substitute help? Well, almost 3/4 of American workers say income stability is more important than maintaining wealth in retirement. Adding a variable annuity distributing 5% can help address this concern by raising retirement income potential while reducing the probability of running out of money, right? And this just gives you an example here. You got a 60-40 portfolio or 65-35 on the right, and you just simply add the annuity, right? And what does that do? Probability of running out of money goes down significantly, and the income in retirement actually goes up. So take a look at this chart. A variable annuity can reduce the portfolio depletion risk for retirees who need distributions immediately and those who can wait for 5 years. And in worst case outcome of running out of money, that guaranteed income that annuities offer continues. Excuse me. So what we have here is income now and the income in 5 years. So we have an immediate annuity on the left, and income 5 years later on the right. And the chance of failure at differential annual distribution rates, you can see a portfolio with a variable annuity on the right side there has a much lower chance of failure at differential distribution rates, right, than a portfolio without a variable annuity. And if you defer, meaning 5 years later, you can see it's even significantly less, meaning that you are deferring the annuity for 5 years and then begin taking out the income right after the 5-year mark. So again, what does a variable annuity do for you, or what can it do for you? It can significantly lower the chance of failure based on high distribution rates. I'm going to skip that one. And again, if you have any questions, here's my email and my website. And let me stop the share here. I'm going to see if I have any questions in